This is Mpoki Thompson for the Citizen Exclusive. We're here in Dar es Salaam. I am with the IMF Deputy Director for the African Department, Catherine Pattillo. Catherine, welcome to the Citizen Exclusive.
Thank you so much.
Now, there's been an interesting event today. The IMF has just launched its report for the regional economic outlook for sub-Saharan Africa. A lot has been discussed. There is cautious optimism about the economic development for sub-Saharan Africa, but also what African government need to do in order to create a buffer to cushion the external shocks. One of the critical issues is now the debt. We understand that international firms such as Standard & Poor, Fitch, and Moody's, they have been accused of assigning unfair ratings for African countries, which makes borrowing very, very expensive. They use quantitative instead of qualitative analysis. Can you share with us what is the IMF doing to help African governments receive loans with not high interest rates? And what's your thought about this unfair assessment that is done to Africa?
Thank you. So there's a lot of interest at times of increased borrowing costs in this issue, and particularly during times when international financial conditions are tightening. And what we see is that bond spreads in sub-Saharan Africa are rising in the context of the current global economic turmoil. And we know that bond spreads in the region rise disproportionately during periods of market turmoil or stress. And that's taking credit ratings as given. So the similar credit ratings don't necessarily lead to similar borrowing costs. Now, what to take from all of this? First, the importance of strong fundamentals. Second, the importance of countries being transparent about the types of things that are really important for their borrowing costs, like the usable reserves, debt and debt transparency. And third, I would note, in the context again of this need for financing, that the IMF is really important for helping countries borrow countercyclically, particularly at times when market conditions might not be favorable. The deeper issue, I think, is really that the weighted average cost of financing for our countries has taken a huge step increase in recent years. And that's due to a number of factors, the end of the era of low rates, to the shift in the composition of borrowing, more commercial, less concessional and grants, and the high cost of debt itself. So the directions people are thinking about, like more blended finance, so far have not really paid off in, on average, reducing this cost of financing. In the longer term, you need things like getting growth up, more domestic savings, but in the interim, we do need solutions, and the IMF, together with the World Bank, others, are looking at how to help countries with high borrowing costs and high debt service burdens, and with debt management as well as operations that could help switch out of sort of high interest rate, short maturity borrowing.
Okay, and do you think so? Africa's been part of the idea of credit rating agency based in Africa. Do you think that could be part of the solution?
Well, it's a complex issue and very multifaceted, but if the movement goes forward, the important thing would be that it would need to be done well, to be credible, to have good information, to be transparent, and all of that takes time. And so if it was done well, having this additional independent information from the region itself could be valuable, but it needs to be done right. And again, as I was mentioning, it's not just about credit ratings themselves, but other factors also influence borrowing costs.
Okay. So now the concern about the credit rating is tied to the debt, and also we understand that many countries in sub-Saharan Africa borrow to implement these mega infrastructure projects. They're capital intensive. However, there is also the concern that return on investment has been very slow. So we are borrowing and investing in these infrastructure projects, but the revenue that's being generated is not really proportionate. So what is your view in terms of priorities that is being extended when African governments borrow? Do you think that there is a misalignment in terms of the priorities, or what's your take on how these mega infrastructure projects are capital intensive, requiring external debt, and now that Africa is trying to wean itself off that?
So the projects and types of investment that countries have been doing have a lot of them been very positive and yielding, again, real benefits, increased electricity access, greater transport, better ports. So they're yielding some returns. Sometimes those returns are long-lived. It takes a while for a big power investment to yield its fruit. But the way that governments have not been doing enough is when the project yields those returns, capturing that increased rate of return through the domestic tax system or through the tariffs. So what is needed then is more emphasis on domestic revenue mobilization in order to ensure that the tight financing situation right now is addressed with sustainable financing going forward.
Okay. Now, in line with that, also, now we're seeing how African governments are trying to secure their financial health. They're turning into gold reserve as we're seeing a decline in the US dollar. So the foreign currency has been shifting of late, which impacts economic performance. What is your view about this strategy? For example, the Bank of Tanzania right now is amassing massive gold reserve, as we're trying to distance ourselves from reliance on foreign currency. Will gold reserve become the primary reserve asset for African governments, and what implication would that have?
So, I mean, looking at it globally first, so the choice of currencies that for international transactions and reserves is a choice, of governments, of firms, in terms of their transactions. But when you think about the global international monetary and reserve system, it has been gradually evolving. And over the last 2 decades, the share of the US dollar in global reserves has gradually declined, which indicates that central banks are doing some diversification away from the dollar. And some of that is higher gold. But gold as a share of global reserve assets is still relatively low. So I think the U.S. dollar remains the world's principal reserve currency because of the U.S.'s deep liquid financial markets, sound institutions, and so it plays this key role in trade and finance, as a state asset, and we don't see those functions. A big change in those functions going forward. Now, for sub-Saharan African central banks, some countries with gold production themselves and the ability to have monetary gold then are using more gold. And you could see that more diversified reserve assets is sensible again for some countries.
Now, just your final thoughts. The report has talked about the optimism. The economic growth for sub-Saharan Africa has been slated to grow by 3.8% in 2025 and 4.2% in 2026. Do you think it's finally time that Africa's economic potential will be manifested globally? As we're seeing these external shocks, but we're also seeing resilience in Africa. Is it finally time that Africa will be able to manifest its true potential?
So our report highlights that there has been a hard-won economic recovery underway, but given these shifts in the global economy right now, that recovery has been tested, and that there's been a setback. The title is Recovery Interrupted.
But the setback has not been as intense. Or
The impact is not primarily through tariffs, but the softer global demand, the tightening financial conditions, the weaker commodity prices, these are serious shocks, and the higher global economic uncertainty. So similar to the rest of the world, we are marking down our projections for growth for sub-Saharan Africa this year and next year. There is, though, as you note, there has been a lot of resilience in the face of 5 past years of tremendous dislocations from shocks. And in fact, 11 of the 20th fastest growing countries in the world are in sub-Saharan Africa. So we've seen some resilience, and there's going to be a lot of need in the next years for agility, for a lot of consistency and caution and credibility in order for that resilience to continue, so that we can get through this and realize the incredible potential of the region.
Okay, well, Catherine, we'll end on that note. Thank you. So that's a wrap for today's episode. You were with me, Mpoki Thompson. We were with the IMF Deputy Director for the Africa Department, Catherine Pattillo. Until next time, bye-bye.